Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of March 2023. What a month March was. The full rebirth of credit risk, the second largest failure and the third largest failure in US banking history, caused by Silicon Valley Bank early in the month. The end of Credit Suisse as we know it, with some bondholders losing everything, 0 cents in the dollar recovery. And the slowing of economic data around the globe in general. It is absolutely our expectation, as we've highlighted for quite some time, that the economies will continue to slow, but the sequencing of these events, we probably didn't expect them to be this severe and extreme this early in that process. What the markets are now searching around for is, are these events isolated firecracker moments that can be ring-fenced, we can put floorboards underneath them and hold the system together, or do they have a network effect and become something darker? Clearly, bond markets have rallied quite substantially in response to these events. I think a lot of folks, both domestically and internationally, are thinking through, particularly their credit exposures. As you well know, we think credit is a wonderful product, but not all bonds are created equal, and it's very important to understand where you sit in the capital structure, because a whole bunch of folks at Credit Suisse found out that they actually sit behind the equity holders, which is quite extraordinary, and thankfully we don't have anything quite that severe here in Australia. But the rebirth of credit risk is really something to think about. Obviously, the big issue here is that those regional banks in the United States do the majority of lending, particularly to commercial businesses, a lot of real estate transactions. And we do believe that this process will starve credit creation. Now, that's very bad for new loans that would otherwise be made. It crimps growth on a forward basis, but it's also very problematic for loans that need to be rolled forward. And that's where we get ourselves into trouble. We've talked about the different transmission mechanisms between economies here in Australia, very interest rate sensitive, very, very immediately because of variable rate mortgages. And we've already got to the place, as we expected, where the RBA have now paused. And we think that that's probably it for RBA rate hikes for now. Certainly the long and variable lag effect of monetary policy will continue to wash over the economy, and a lot of fixed rate loans which were made on honeymoon kind of rates after COVID will expire, and that will generate a quite substantial tightening in the domestic economy. Versus something like the United States economy, where people can borrow personal mortgage monies for very long periods, 30 years. It's very hard to get them to slow down by moving interest rates, because they've obviously got their monies locked for long periods. So it's more likely that we'd see issues through the corporate system, and that's exactly what has transpired with Silicon Valley Bank, although it is a little technical, more technical than that. The net result is it's causing flares and requiring policy response from central bankers who really do need, if they are to come with a larger policy response, they need inflation to continue to fall very rapidly. Now, the problem with that, as we've again articulated, is that it's the energy piece in that story which is very difficult to predict. We've had OPEC production cuts already this month. Oil prices have spiked. But we know if we do crimp demand enough, then inflation will be slain. And it will continue to fall until the middle of the year, where thereafter the pathway forward gets a little trickier. So it's not easy to see a series of deep interest rate cuts and quantitative easing, the magic potion that saved us from every other issue that we've experienced since the GFC, if inflation is still hanging about. And that will make this cycle quite different and somewhat unique versus other cycles that we've seen. It's really interesting to see the way that markets are reacting. Obviously, lower bond yields initially help equities rally, but it's important to think through, why are yields lower? Are they lower because we have this immaculate disinflation and we can go back towards a more status quo world where bond yields can be low and that supports high valuations for asset markets? Or are they going lower because there's something nastier and it's more of a flight to quality move? Because previous episodes we've seen risk assets ultimately won't like that. So there's a lot of questions to answer. They're not easy questions to answer at this stage. And I guess in response to that, the bond market's pricing is sitting here that looks expensive, to be honest, if we are to not have any further issues. then rates probably won't get cut and yields might pull back a little bit. If there is a bigger issue, then they look extremely cheap. And so it's not unsurprising to see them washing around in this middle ground with a foot in both camps, waiting to see if there is a network effect. Do we have more bad stories coming? The answer, we think, sadly, is yes, we do. You've only got to look at, say, the construction industry here in Australia, which is starting to fall fairly rapidly now. I heard yesterday that we've had 50 building failures, building corporates in Queensland alone this year. Not even almost 100 days in. That's a company every 2 days going down. Subcontractors affected, people with unfinished projects. These are nationwide issues and they will continue to flare. And we know that interest rates and the full effect of those rate rises are only partially in the economy at this stage. So it is going to get a little bit harder before any kind of relief might be provided. So all of those questions, I guess, are things that we're thinking through. The macro environment just continues to move very, very quickly. But we are at that stage now where different jurisdictions are going through, different parts in their own cycle. We've seen the Reserve Bank of New Zealand continue to hike, whilst we've had pauses from Canada. We've had pauses in Australia. We're very close to the end, we believe, in the US, and maybe a little bit more to do in Europe. And of course, Japan hasn't even got off the starting grid yet, but they probably do need to do so. So there is a lot as we look across the global macro landscape that will affect both rates markets, FX markets, and risk markets, and the flow of funds and the way that monies will move in order to try and navigate those currents. For now, again, bond markets, after a difficult year last year, have provided great stability, and they are performing in that kind of negatively correlated sense. We've always believed that under stress they would continue to provide that anchor role in a portfolio, and pleasingly they are doing a very good job both financial year to date and in the calendar year of 2023. Thank you very much.